So a lot of this is about patience. A lot of this is about belief that every business will go through a down cycle. It has to. There's no business that has compounded profitability about 15% for the last 20 years or 25 years. Nothing happens that way. And that's like you have to wait your time and it will come. So that's why investing becomes long dated. It has to be long dated.
Hello and welcome everyone. I am Vishal Khandelwal and this is the 1% Show. This show is an open-ended exploration into the minds of the wisest people around to help us learn to think, invest and live each day as little as 1% better. You can learn more at safalniveshak.com. My guest today is Kenneth Andrade, founder and CIO of Old Bridge Capital Management, Old Bridge Asset Management. Kenneth has over 32 years of work experience in equity research and funds management, which includes a formidable track record managing some of India's most successful equity funds. His experience in portfolio management includes the 10 years at IDFC Asset Management Company, where he was responsible for the performance of a corpus of more than $8 billion as CIO. He was responsible for building the firm's equity franchise and managed one of India's largest equity funds by AUM. Kenneth has a Bachelor of Commerce degree from NM College of Commerce and Economics, Mumbai University, and postgraduate diploma in financial management. While researching for this conversation, I read this story on Old Bridge Mutual Fund's website about ancient Rome, where when a bridge was constructed, the engineers of the bridge had to stand underneath it when the scaffolding came off. With their lives at risk, the engineers left no room for error. And to design for safety and longevity, the engineers ensured that the load carrying capacity of the bridge was much higher than the actual or expected loads. They thus built a higher margin of safety into their construction. Kenneth, with his work on money management over the years, is trying to do exactly that. As he mentions, his priority is to buy enduring business models with emphasis on limiting capital losses, which is why he gives great emphasis on buying at the right price and value. In today's conversation, we are going to delve deeper on these aspects of Kenneth's investing principles, apart from knowing him better as an individual, and especially his secret of maintaining a calm, quiet and steady external self, which I'm sure is the result of a calm and quiet inner self. With this and no further delay, Kenneth, welcome to the 1% Show, and thank you so much for agreeing to do this.
Thank you, Vishal. The pleasure is all mine, and thanks for that lovely introduction. I would never have thought of all that good you put together there.
It's been great. I think your experience over the years and the lessons I've learned from you over the years have been phenomenal, Kenneth. So thank you so much for that. So to start with, Kenneth, just the introductory question, right? A bit of your background, but a background before you started work. So where did you grow up and how were your earlier years like before you got into work and investing? Also, when you look back at your past and growing up years, which are those most important lessons you learned that have contributed to making the person that you are today?
I think it's a very long time back. I just realized from a personality perspective, which I still carry around with me, I've always been a loner, right? And when you spend too much of time with yourself, you get to do things. You get to do a lot of things, and once you choose a certain vertical that you like, you actually deep dive into it completely. And that's what my early upbringing was. I was never into any of the outdoor activities. The only two things that I liked was reading and listening to a lot of music and reading a lot of music also. So the only two things I liked, and one of those had to become a career. But unfortunately, I could never play an instrument. And the other extreme is I love reading so much, and over a period of time, I just got encompassed in financial journals. And that, I think, is what defines me today. So I still read a lot, but a lot of it is really financial journals and picking up a lot of information from virtually all over the world. And 87 to 1985 to 1990 and 91 were probably the formative years of what I do today. Why 85 to 91? I think that was the beginning of just pre-liberalization. That was the beginning of capital markets. A lot of activity was going on, and I remember this thing very clearly that the capital markets, especially the IPO markets, were at its boom. Okay, and I picked up straws from there and utilized a lot of it through the 90s. So that's a period of time uh, that did well for me. That did well for me in terms of how much data I could assimilate, what I could do with that data came well after.
That's great. That's it. And you've been in the markets for almost 3 decades, more than 3 decades, and money management for more than 2 decades. But if you were to describe the Kenneth of today that you know of, what does he do in simple words, and why does he do it? So basically, what's your North Star? What drives you on a daily basis?
Well, I like to be right, and I guess I spend most of my days trying to do that. And it's not just and it's not just in investing, in just every aspect of what I try to do. Right, and when you try to be right, you try to look for you like to look for justification or reasons why you need to change your opinions on some things. And that's what drives me, and that's why I come into office. So if anything that is not right, as simple as the decor in the office, or the chairs are not put into place, uh, or or the battery is not there, it bothers me. So just putting things in place is what I like to do, and that's what drives every part of it all. So when I fix get a mindset of putting 25 stocks into a portfolio, which I keep doing. 26 is not acceptable. Okay, I try to work with 20, but 26 is not acceptable, and that's what drives me to to figure out how do you choose the top 20 businesses in the country, or top 20 businesses that work for your portfolio in your investing style. So that's what drives me. That's how I like to look at things. That's how I like my team to look at things. And I welcome all ideas from all over the place. So I'm very open to ideas. I like to have conversations, and I like to listen a lot. I'm not a very conversative person.
So, talking about 30 years, 30 plus years, that I think isn't a long enough time for individual to evolve and investor to evolve as well, right? So, how has the evolution been for you? You started, as I understand, in the publishing business for some time in terms of Capital Line, if I take the name right, and then you gradually moved towards money management over a period of time after being an analyst for an interim, right? So, how has your investment philosophy evolved over this period of time? And if you were to take a deep dive into investment philosophy as of now, your philosophy, what are those core principles that guide you to make your investment decisions at this point of time?
Okay, if I look back, I've been pretty experimental, right? And the thing that the thing that has changed today is that I've made a lot of mistakes. What I try to do today is not make those kind of mistakes. Okay, I mean, you've been there, you've done that, and that's what you want to do. The 90s was all about what should I say? Following a trend, about picking businesses or picking stocks that other people told you were good. You do some basic homework, and you said, okay, this is the way to do it. And I call it the phase of tuition fees. Okay, the entire 90s, you lost more than you made. And the 90s was it was a very difficult period in Indian investing in India, or investing in stocks. I don't think the last 25 years of investing has come anywhere close to the 90s. Okay, it was really a terrible year. I saw markets more down than they went up. And you lost more money than you actually made. And the sums that you lost are very tiny, but they were significant from where we came through. I came from pretty much a lower middle class background in Bombay, but always struggled to make money through the 90s. So you were more out of pocket than in anything else in the 90s. And I think that's where the experimental base came. What about which stocks to buy, how to put them into place, and that's where it came. And then it came the late 90s and into 2000. That was a brilliant period because everything you touched moved. Okay, and that's where you started having uh, what I developed was a reasonably large ego. Okay, which comes with success at that point in time because of the market success, and you just participated. And post that, it just collapsed. So that was a phase where it was growth investment. I mean, chasing a trend, you saw that bubble come through and participate with the bubble, money multiplied itself. And that taught me never to do that again. 2008, you avoided it completely. Okay, and 2000 and that after that there was no turning back. So I simply put it together. If I had to define a certain sentence in my investing style, is that you pay a price for capital efficiency. You do not pay an indiscriminate price for any stock that is out there, and that's where the basis of what 2000 taught me, or 2008 helped me succeed. Okay, and 2008 to 2015, I just followed the same principle and did reasonably well over that period of time. So 2007 to 2015 were some of the best periods of my investing career. 2000 and post that, it continued to compound at the same level. So I think that's how the trend evolved. The thing now is when I put myself in a portfolio manager's shoes, on my own shoes, and look at my portfolio. I come to work every day with holding the same principle. You buy a business, you buy a capital efficient business at a price. Okay, that price, and irrespective of how efficient capital is, you're paying a price which is equivalent to what today's price is. So your ROE, okay, your ROI has to be on the price you're paying it today. So it's very mathematical for me. And if things don't add up, we know what to do. Okay, and I think that's how the situation has evolved, which is where also why Old Bridge is defined the way it is. Okay, we like to have a significant margin of safety, and then the margin of safety has to be in numbers.
Sure. I think as part of the principles that you mentioned for Old Bridge, and I was going through a mutual fund document for that, you mentioned that you look at 4 parameters while considering to invest. And the first is you look at consolidators of the industry. Then you look at capital efficient business. You also look at low financial leverage and low valuations. So in simple words, if someone were to understand your investment philosophy, right, can you just explain these 4 various parameters of what exactly that we look at in businesses, right? And if you can give an example each without naming a stock, but a broader example of how you spotted an investment opportunity based on each of these parameters.
Sure. That's simple because when we say we like monopolistic business or consolidators, we love a company of gaining market share. But you can gain market share by throwing a lot of money at it. Okay, which where the capital efficiency actually comes from. Okay. So our first principle, or what I like best about any business is a company getting market share. And the efficiency of capital comes in is because if the company gets market share, or the business gets market share, without addition to the denominator, without increasing capital employed, there's nothing better than that business. I mean, he's got everything right for himself. Okay, and that's where capital efficiency comes in. Now, there's a catch, because what's capital efficiency for us? Okay, a capital efficiency for us is when an industry is making a loss and there's one surviving business that's making a 7% ROE or ROCE, which is below the cost of debt. Okay, you're sitting on a no-brainer. Either the industry closes down, or that business is going to generate a significant amount of cash should the industry actually turn around. So you catch in a company which is accumulating market share. You're capturing a company that is getting customers, getting market share at no incremental capital employed, and then you're just waiting for the entire cycle, which is why we love the business on the downside. And if you put that two together, I think at the end of the day, you get valuations which are right. I step back to 2015, 16, 17, where we were buying utilities at that point in time, and we was talking about the ESG phenomena. Okay, but our plants were available at 30% to its replacement cost. Okay, what do you do with something like this? So put this 3 together, and I think you got a stock that's got longevity in your portfolio. The where did all this come from? I think go back to one industry which is very large in India, but is hugely cyclical, and a lot of government intervention, which is the sugar industry. Okay, 90s, one company was making money, everyone else lost money. The company's ROI was less than 10%. Okay, Barrampur Chini. 2008, 2004 and 5, company did that again. Okay, and in every single cycle of the sugar cycle, this continued to keep happening. And at every sugar cycle top, you used to have the smallest company become the largest company and disappear in the next cycle. So if you just stayed with the survivor, a very basic business, if you got it right, compounded capital, better than the marketplace. So I think those are the principles that we follow. Get the business which gets get market share. Get it at an efficient. Get it with efficient capital. Valuations fall in place. But if you have to catch survivors in the entire business, you've got to manage your leverage or be actually debt free in that entire process.
I think we also have seen a illustration which you've put out on your website and through your communications, where you've defined the corporate cycle, and you've also defined how investors react to it, which is contrary to the corporate cycle. So the cycle is on upturn and investors nearly buy at the peak. So I'll for the benefit of the audience, I'm going to show it on the screen, but I'm showing this, what exactly I'm talking about, the corporate cycle versus how investors behave, right? So my question is, can you explain how an investor can learn? One thing is to know that there's a corporate cycle and investors behave contrary to it, but how can one learn to play such a cycle instead of going against it? Because this, I think, is very, very difficult because it's like going against the herd, right? What most people are doing, you're trying to go against that, right? So one thing is experience, long experience in investing and seeing through market cycles and corporate cycles, and to know how to deal with it, right? But what else, according to you, is required to build this ability to study and benefit from cycles?
I think most cycles are captured in valuation, in the valuation paradigm. Everything is captured out there. And if you just keep looking at, so one simplest way of looking at it is go back to 52-week lows. Okay, and keep continuing to look at 52-week lows, and you will find a pattern. After a point in time, an industry which is not doing well, all companies start making 52-week lows, and there are some insolvencies that also. I think you'll capture it there. So the simplest way that we tend to look for it is just look for companies that are not doing well. And once you've been able to find a pattern in that, figure out what's going right, figure out what's going good, and just buy the survivors of the cycle. And I think that's how we start, and that's what we do. And even in the marketplace today, though you don't have too many businesses which are at the bottom end of the entire price spectrum, it's a very difficult environment at this point in time for stock picking. But if you do not have a company which is at the bottom end of the entire cycle, but you still have businesses which are not doing well, which are fallen on the wayside, and there are challenges that are emerging. So what was the playbook in, say, 2020, 2021? Businesses some of the companies were doing very well. They gone through a reasonably tough period and they're not doing well today. Okay, all those have to be on your radar. So you have to look at price points, and you have to look at where the valuations stand, and then you have to look at the industry from a paradigm as to how many companies and how many businesses are really making. Always look for incremental capacity coming up, because the more capacity comes up, the lesser pricing power, lower fees have to come. And I think that's the format that we use. So there's a mathematical way to arrive at it. And all the answers are there in public domain. So it's not very difficult. It's just a lot of discipline that is required, and you've got to eliminate a enormous amount of noise. I mean, you go to the electronic media, you go onto electronic media and digital media. There's an enormous amount of noise out there. It's all pointing in the wrong direction.
That's it. I think you talked about experience as well. I remember reading somewhere a quote attributed to you that one learns to become a better investor after one crosses the age of 50, because you know that how to avoid making a lot of those big mistakes that you made in the initial period. Is that true? Is that true? Is this, in your experience, is that a long period of time? Surprisingly, the reason I'm asking is that there's something peculiar about investing, that it takes us to go beyond 50 years of age to avoid making a lot of those mistakes, which we generally do well in other areas of life. So we learn to avoid mistakes in other areas of life, but something is there with investing that it takes a lot of time. So how's been the experience over there?
So I think you accumulate your mistakes over a period of time, right? And investing doesn't come naturally to most of us. So the earliest generation of investors came in when probably they were 16, 17, 18 years old. Okay, and you had 3 cycles. In all 3 cycles, you made different mistakes. Okay, and there's enough of mistakes that you've accumulated to in the next cycle make sure that you make less of it all. And by that time, you've also defined your what works for you and what doesn't work for you. Okay, and once you define what doesn't work for you, you just don't go down that path. And once you don't go down that path, the rest is all okay. So investing is not about getting everything right. Investing is about getting nothing wrong. I think once that part of it is taken care of, the rest is quite okay. So just avoid solvency issues and just avoid a lot of debt. Just avoid high price earning multiples. I think you'll be right.
I think that's a great statement that you made, that investing is about not making a lot of mistakes and rather than trying to be right, you try to avoid to be wrong. We all are playing, I think, a game of long-term investing, which is long-term compounding, while ensuring that we don't hit upon disasters, because disasters really hamper our journey in this wealth creation space, right? Now, this is, I think, a sort of a get-rich-slow approach that requires, as you rightly said, to avoid a lot of dumb behavior. Like what Charlie Munger says, that avoiding standard stupidities and you do fine in life. So can you share some of such behaviors? So apart from the numbers, low leverage and low valuation, like reasonable valuation, but in terms of behaviors, can you share some such behaviors that you try to avoid to not create catastrophe along the way? Something that does not interfere with your long-term compounding journey.
Yes, I think over the last couple of years, and especially after 2018 into 2019, right? One thing that what I've realized is never rush into buying a business. Okay, in my earlier days as a mutual fund manager, it was quite easy to go down that entire cycle. The company comes into your office, you like the business model, the analysts have all got a buy report, you bet it first. So it's very simple to get aligned with this thought process, not knowing enough about what that business is doing. Okay, there's always the fear of missed opportunity because the industry is large. I think we have to put that behind us. Okay, because there are over 1,000 stocks which are investable. Okay, and in my life cycle, I've never seen a company or a business being available at a price that you want it to, irrespective of where it's gone before. It's always come back to a price that you had wanted to own it at that point in time, and that's very hard. So a lot of this is about patience. A lot of this is about belief that every business will go through a down cycle. It has to. There's no business that has compounded profitability about 15% for the last 20 years or 25 years. Nothing happens that way. And that's like you have to wait your time and it will come. So that's why investing becomes long dated. It has to be long dated. You have to take that time to wait for the stock at that point in time. And you have to move on to the next one. Okay, so opportunities are massive in this industry, and there are plenty of them out there. There are a lot of smaller businesses that are coming through with a lot of potential. There's no need to buy it in the first round. Go back to an industry called pharmaceuticals. Missed it in 2015. It's coming back. Okay. Go back to infrastructure in 2008. You missed it 2008. Look what an opportunity it gave you right through the entire decade to buy it again. Okay. Missed consumers in the last cycle of 2001 to 2011 to 2020. You're getting a bear phase in the entire market all over again. So that's a cycle that will continue to happen, and I think that's something that we've ingrained with ourselves, right? You just have to wait. If a business is going to grow, it's going to grow in perpetuity. You just have to wait for that business to go through a down cycle, get more customers at the competition's expense at the uh, comp- from the competition, and valuations will correct, because no one likes a losing business, or no one likes to invest in an industry which is not making money, and then that's when you become the only buyer in that space. So I think that's one thing that I think we try to institutionalize, or I try to institutionalize with my entire colleagues. Of course, I've got a very young team. Everyone's seen a reasonably short cycle, and everyone thinks that they will miss the next big thing. But it's a long dated process. You just have to wait your time.
But how do you teach the idea of longevity? So you talked about business longevity, right? Which is, I think, of paramount importance for you while making investment decisions. And you've studied hundreds and hundreds of business over the years, and I'm sure you found those characteristics, not just in the business, that can lead them to survive multiple cycles, but also build value over multiple cycles, right? So you've learned the lesson. But since you mentioned about a young team, right, or talking to young investors out there, what exactly do you teach them to ingrain that idea of thinking long term, longevity, survivorship? Because they've not seen that. You've seen that. So how do you train them?
So we've got so we started off in 2016, and that's our first portfolio, and we still got two stocks which are from 2016 to 2024 in our portfolio. Okay, and we had between 2017 and 2018 a lot of businesses that we got rid of only in 2023. So one, you're going to spend a lot of time trying to figure out whether this is a company you're going to stay with for the next 4 years, 5 years, or 6 years, or maybe longer. And you've got to be sure that these are companies that are going to create those franchises, whether it's domestic or whether it's global. Okay. So now there are two things about longevity. A lot of businesses survive because they don't have debt. Okay, all you need is a good capital structure, no debt, and you will survive for as long as you. Because every business goes through a cycle. A lot of these companies will come through, and I've seen a lot of companies that keep crawling out of the woodworks in every bull market, but they get clean back again, because there is no business plan, and there's no management thought process on how to build a franchise. So financial discipline and building a franchise, you combine the two, and I think your business has got longevity with it. Okay, and there you have to take the opportunity of which other companies are there in the industry which are making mistakes. And if you find enough of those companies, you know that the business that the stock you hold, or the company that you're looking at that point in time, is going to come up at the top of the scale, or top of the industry at the end of the cycle. So for us, we tend to hold companies at least for one full cycle, and first of the down cycle and then at the up cycle. That's how I would like to do it. That's how I would like to do it. Nobody knows when the cycle is going to turn, but you can see the industry consolidate itself. You've seen weaker players actually go out, and you see the survivors actually accumulate market share. I mean, there's nothing that works better than a company accumulating market share. And I think that's the only thing that I ingrain with most of my colleagues. Look for a company that takes market share at the expense of its competitor, and we will come out on top.
What about management quality? So one is business longevity and value creation. And I'm sure management quality is not really much differentiated from that, because it's a good management that really leads to a good quality business, and not the other way around. But when you look at management, apart from a clean balance sheet, apart from the company's ability to take market share from competitors, what exactly do you look at in management when you talk to them, or when you analyze them while making investment decision? So that is one. The second thing is the third leg of the investment decision making, which is valuations. So what is your mental model of thinking about valuations when you're looking to buy a stock?
So governance and management can be quantified. Mm-hmm. Okay, I've talked about market share. So obviously he's getting customers that need his product, and his product is superior than the rest, and the customer actually believes that he will be in existence for an extremely long period of time. Second is employees. No one wants to join a losing company. Okay, so company that's winning on a daily basis will attract the best talent from its competition. Okay, and we don't need to, and that's the only thing that we check every time we meet managers or go to a plant visit. The business has to attract the best competition from its stakeholders. Okay, we know equity, we know debt, we know uh, we know the government. So those stakeholders that exist, of course, the customer and the employees are the biggest stakeholders out there. So I think all of this can actually be quantified with what companies are, or what businesses what businesses can attract, and that's a quantification of it all. The other thing is financial discipline. Okay, and there is enough of data now to show that that a lot of the companies out there have the financial discipline to make sure that between the promoters or the management and the stakeholders, they are all treated on the same platform. I think those are some of the basic things that we do with checks on in terms of evaluating management.
You build a thesis on investing, and this is, I've seen a lot of investors, even with a lot of experience, right? There's always a confusion between how much time do you actually give your thesis to play out. One is to take a stand that I believe in my story, but how much time do you personally give as a fund manager for your thesis to play out? And from your past experience, can you talk about one broader example of when you believed in something, but that thesis did not play out and you actually have to exit with that opportunity?
Yeah, so it's very simple, because if you just take those 4 parameters that I put together, right?
Yeah.
Quality management, businesses which are monopolistic and consolidated. Return on equity is great, or capital efficiency is great. Okay, leverage doesn't exist, and valuations are familiar. Now, if you buy 20 companies in that business with the same parameter across different businesses, right? 8 of them won't make money for you, with no downside. But you've got to be very unlucky for 20 of them not to make money. All right. So when I looked at the characteristic of the portfolio that we built, characteristic of the portfolio all has to be similar in terms of where these stocks come into the portfolio. After that, they all break out. Okay, every industry has got a different business cycle, and all of them break out after a point in time. So when you're building a portfolio, we just make sure that all the characteristics of the companies are the same. That every industry follows its own business cycle, and that's all. So for companies that we've owned, as long as they're not doing anything disastrous, I think we could have a fairly long growth. And when I say the long growth, I said some of these companies have been on our portfolio for the last 6 years, and have given us a single-digit IRR in a marketplace like this. And that single-digit IRR is also because the market is where it is today, and not because the company is something extraordinary. Okay, but neither is market positioning getting destroyed, neither is the financial numbers actually deteriorate. When I say deteriorate, in terms of leverage come up. Shareholders have been fairly well rewarded. So dividends, buybacks, all of that has been there, and valuations are fair. Now, the thing with a business like this is, if it's in low double digit multiples, it's that you're with the dividends and buybacks, you're actually getting paid to hold the stock. So it's not a zero sum game in terms of giving a company time for the cycle to play out, or giving an industry time for the cycle to play out. But that ranges. I think the longest that we waited on a company is almost 7 years.
7 years. Okay, that's great. I think so. We are living and investing in times where change is happening very fast, rapidly. So the world is evolving, the world is changing, and given this environment, I think one of the best abilities, or the greatest abilities one can develop as an individual, is the ability to change your mind when the facts change. Right. So my question to you is around this topic of changing your mind. What is the most important thing you have changed your mind on in the past few years?
So we never fixed. I mean, mind shares are never fixed. You just use what has worked for you in the past, right? So let's put it this way: when you build a portfolio, when we build our entire portfolio, there's a constituent that we put together, right? What we have today is very different from what I have in 2016. And when I put it in 2016, and it came out, and I came through after a decade with in my previous organization, I had a very consumer-oriented thought process. I actually thought consumers were the best thing ever. Okay, but when I get through in 2016 and put a portfolio together, it's that when you used to buy a business at 15 and 16 times earnings, okay, that was investing. If you have to justify the same thing because it's worked for you in the past at 40 times and 50 times earnings, that's not investing, right? And that's how we shifted our thought process. The portfolio constituents always change. Okay, the methodology remains constant because that methodology is always worked for us. Now there was this brief period that was there in 1890, okay, uh, which uh, which stopped us out completely. Uh, the process that we employed, or the process that worked for me since 2002, 2003, when I first formally started managing money, just wasn't working. And it was really painful. The first time in my career that I lacked the index almost 35%. All right. Now, at that point in time, you either give up and follow the herd, or you just wait and go back to your mathematical equations to see if things were actually so bad. And then it actually works out. Always go back to numbers. Let the numbers and let the statistics talk for itself, rather than price action. Price action make you do something that is not in your DNA. But if things permanently change for a very long period of time, then maybe we need to take a relook at what we're doing at that point. So 1819 was difficult, but towards the end of 19, when we just about coming to 20 happened, but 21 onwards, everything reverted to me. So all that we did was waited through that entire cycle. So out here is not about we didn't want to change, but we just stepped back and said that this is the way the numbers that we put together do not add up. We took an unbiased approach to just quantify what we were holding, rather than looking at the marketplace and seeing price action actually delivering what returns. And at post that we are pretty much okay. It's something very similar worked out in 2007, 8, and 9, wherein you had a consumer cycle which was a 10% cash flow yield, which was FMCGs, and you had infrastructure businesses which were negative cash flow for next 3, 4, 5 years. I mean, we did that back at that point in time, and you flip these equation out there. So then again, numbers work well in our favor. This time again, numbers work well in our favor. So you let math do the talking, or let the numbers do the talking, rather than say that this is where I want to be and this is where I do not want to be.
Mm-hmm. I have a question about the dilemma that most investors face, which is of walking a thin line between confidence and overconfidence, which I think is the worst bias to have. And now, if you are a contrarian investor, how do you know which side you are on the side of confidence or overconfidence? So is math enough that you mentioned, the math of investing and the math of the businesses that you're looking at, enough to tell you that whether you're confident or you're overconfident in your investment decision making? Are there any behavioral thumb rules that you have to differentiate between the two?
So Vishal, it's for us. When I say that we buy capital efficiency at a price, right? That's essentially what we'll go back to. I think what I'm saying is what you can put together on the calculator, right? And if it has worked for you in multiple years, and it has worked for multiple investors ever since the beginning of investing, okay, it's a cycle that plays out at various periods of time. If you're putting 100 rupees to work and you're getting 15 rupees back, okay, there's nothing wrong with it. Okay, but if you're putting 100 rupees back, then you're getting 3 rupees back, and that stock price keeps going up. So the next day for every rise in the stock price, your return generation is going to be lower. Okay, so you have to swap it out. So I think the behaviorally you have to just not be contrarian, because contrarian is actually is actually following the price, and looking at a lower return in future. Okay, the simplest thing to do is that you're sitting here today in 2024. Okay, your portfolio, if you look at your portfolio, nothing is losing money. Maybe there's a one odd stock that is actually losing money, but everything is making money. Okay, but 2024 portfolio was made in 2021. Okay, you got a 30% CAGR since 2031 to 2024. If you're buying the same amount of this same businesses today in 2024, remember all your returns have been upfronted. Back-end returns are going to be lower. Okay, so I keep saying this in most of my communication is that I'm extremely bullish on the economy. I'm bearish on returns. Okay, now flip the argument. Go back to 2030. Okay, what's the next biggest thematic that money managers will launch? Okay, will it be the same thing that they're doing today? It's just not possible. It's just not possible, right? And I think that's the framework that you need to put there, because investing is about compounding returns. Okay, what's the best way to compound returns? Okay, and this is what every investor has experienced, but no one looks back to see how they've compounded returns. Okay, earnings go up and price multiples go up. Okay, you have two variables that are compounding your capital. But if price earning multiples are already high and you only got one leg to run on, okay, you are taking the biggest risk of saying that there's going to be no execution challenges with that company or that industry in future. So if you look backwards, okay, to justify what you've done today, you've got to look forward to see what's the next large opportunity that is coming. And that large opportunity that is coming is something that nobody has today. And you pick up any cycle, or I could pick up in my 35 years of work ex that I put into this marketplace, or 35 years of investing experience that I put into this marketplace. The most unpopular stocks or industries have made you the maximum amount of money. Okay, and once they made you the maximum amount of money, they go on to become like the most unpopular stocks after that. And the cycle changes there.
So broadly, you mentioned that you're bullish on the Indian economy, but bearish on returns going forward for the obvious reason of, I think, valuations that that are pricing in the most perfect scenario, the blue ocean scenario, blue sky scenario, whatever it is called. If you were to look at the next maybe 10 years, the next decade for India as a whole, or for Indian investors as a whole, right? What are you most bullish on? Bullish in the sense optimistic about, and what are you most pessimistic about in the sense that I've heard a lot of investors, experienced investors saying that the biggest problem with Indian economy and Indian markets in the past has been self goals that we've been hit on us, right? The mistakes that we've committed ourselves, even when things were going wrong. At this point of time, maybe valuation is an issue, the price to earning multiple, which is the second leg of the stool apart from the earnings growth. So going forward, next 10 years, what makes you the most optimistic on the Indian economy and markets, and what makes you not pessimistic, but where would you keep your eyes on in terms of the risks that you can foresee?
So risks are not in the balance sheet. I mean, all corporates are fairly solvent, government pretty okay, household balance sheets are a little bit leveraged. I'll worry about that a bit, but there's nothing that is going to be a systemic risk. So if we look at India, I don't see anything systemic actually coming through, right? On the international side, there could be turbulence. There's a lot of geopolitical stuff that is happening, and I think there's one constant which is out there, and this is where we sit as an economy, right? We have 17-18% of the world population and 3.5% of the world GDP. China used to be somewhere out there, and now they're 58% of the world GDP. So if we have this 3.5-4% has to go to 5, 6, 7, 8%, right? And if you look at any economy that is more from a developing economy to a developed economy, we've gone out there market shares. So what do I chase here? Okay, we have one large industry in India. Okay, that has got enormous amount of cash flows, and it's got the world it's got the world, which is its marketplace, which is basically IT services. Okay, so I'm putting a piece together for our investors, and I just keep talking about the entire thing. You look at Japan, you look at Korea, you look at China. Okay, what did they deliver to the world? The world's largest automotive company, which is Toyota. Okay, the world's largest semiconductor company, which came from Taiwan, and the second largest electronics business in the world, which came from Korea. Okay, what can India do? Or which are the businesses that are going out actually capturing that? So this is a hypothetical an example. Today, Maruti trades at 2x the market capitalization of its parent company, which is Suzuki. Suzuki, I think, is about $24 billion, and Maruti is about $49 billion. Okay, Suzuki's holding in Maruti is higher than its existing market capitalization. So that's the anomaly that is sitting out there in terms of valuations. The second thing is ABB, India, ABB in India, and at the peak of ABB stock price was 30% of its global market cap. Right, same thing happened with all the parent companies, etc., etc. So that's the format that's out there, but that doesn't mean it's bad, right? What happens if Suzuki uses the car company in India, its subsidiary in India, become a global powerhouse, because Suzuki is not the global car automotive business, and that opens up a new leg of opportunity for any car manufacturer. You've got car manufacturers in India that are trying to do this, but that opens up a different opportunity for car manufacturing in India, automotive manufacturing in India. You see it in IT services, you see it in pharmaceuticals, you see it in chemicals. Okay, and I think those are the sweet spots for us, wherein you could address the marketplace, and your profitability is not constrained by the growth of the Indian economy. The only challenge that I see out here is that none of these businesses have an IP really to talk about. Okay. So we're very far away from being competitive in high tech, but we definitely can take away market share from a lot of other businesses where I would say we've built a significant advantage, and not based on subsidy or based on currency or based on cheaper manpower anymore. We're just competitive with the stuff.
Moving on from the investing side of you to more of a personal side, of course, cannot take away the investor within you, right? You've been a public money manager for years now, and I'm sure the demands of a public money manager are much, much higher than demands of being an individual investor, especially because you oversee large sums of other people's money and you must act as a fiduciary. You need to deal with a lot of information overload. You need to deal with markets irrationality, and each of your decision and outcome is publicized. And also because money management itself has become such a competitive field, I'm sure all that exerts a lot of or fair degree of pressure on you. So how do you keep yourself balanced, calm and sane amidst all these things and other challenges while continuing to enjoy what you're doing? Basically, what is your support system?
So I tend not to take too much of pressure. Simply because been there, done that. The field is much more competitive today. Obviously, we as a business or as an investor are not out there to be the biggest, largest, fastest growing business in the country. We've got excellent investors with us, and whoever has stayed with us and has remained with us have been extremely long term, very patient, and at the end of the day, they've been rewarded with multiple cycles that have gone through with us. So we are under no pressure to do all of that. So being a public manager, public equity manager, uh, uh, okay, and I take this from my last experience with IDFC. I used to run a product out there which was closed for subscriptions and open for redemptions. I did this for 10 years. Okay, you just have to be consistent. You just have to make sure that, and when I say consistent, you also have to be competitive, because I can't stay at the bottom end of the quartile of the. I can't stay at the bottom quartile and expect investors to be with us, right? That's also one of the reasons that we're having this conversation. Okay, but if the process works and just align yourself with the process, you know you're coming back. So you have to keep the communication open. Okay, it's the investor money. Finally, he makes money. He's not happy with the performance. Not happy with the portfolio. He's not happy with something. It's his money to go away. So we accept that format. That's the first thing that you do as a money manager. Okay, and then just wait for the process to come through. I think we are very fortunate to be in the asset class that we are in, and in the phase of the world economy and the Indian economy the way it is, money will compound itself. Sometimes slower, sometimes very aggressively, and then you throw in a process which has worked historically and has worked to your effect. I think the outcomes will be perfectly balanced. So it's that optimism that keeps the pressure away, I think, more than anything else. I've got a great set of colleagues. I work with some of them for an extremely long period of time, and they've been through multiple cycles with me. So I think colleagues, family, very few friends to talk about, but if you put that all together, I think they keep me sane.
I'm so sure. Talking about noise information, I'm sure you are surrounded with a lot of noise that we talked about. And we are living in a world where information is not an edge. Everyone has the same kind of information. But it also tends to create a lot of problems for us, because we are often dazed and confused about what is the right information with a long shelf life, especially when you're a new investor, right? And given all that, how does one really go about building that independent thinking mindset that is so important for an investor? So what is your advice to new investors on how do you actually deal with information all around, and doing that, build a independent framework of thinking?
I think it comes with experience. You have to go through one or two cycles to know what's right and what is wrong. I mean, today so the narrative always sells,
Right.
and that's what's in your face. But you go through what I went through that cycle in year 2000. The narrative was in my face, and I was the narrative in technology, tech. Okay, where it came to the commodity cycle and infrastructure cycle, I knew it was not sustainable. The thing was, you were 6 months too early, or maybe you were a year too early, but you were there. So I think it's the experience that going to help you through. So don't try to avoid mistakes, because you won't be able to avoid mistakes. The mistakes will come, but make sure you don't make the same mistake again. Right? And I think that's the cycle that for investors, it's very simple. Whatever you're doing now, if you're late in the entire cycle and you participate in where this, you will make your mistake. Okay, but don't let that scare you out of the cycle in the next round, because the opportunity of equities is to actually buy it over. You make more money on the way down than on the way up. And I've seen this multiple periods of time, that you are attractive to equities because historical returns are good, but that is not going to make money in the future. You've got to stay the course and double down where returns are bad or really negative. I think once you've been able to double down is when you come back into the cycle. But that takes a lot of discipline. That takes a lot of practice, and you will go through that cycle pretty much. And I think pretty much in this decade for sure. But you have to double down. For investors, it's very simple. And I think the industries done a great job. Mutual fund industries done a great job in terms of making sure that they take smaller packets of investing and creating a smoother curve and smoother experience for investors over a period of time. But the thing is on the down cycle, on the bear markets are where you make the maximum amount of money, not in the bull market cycle. That there is a time to harvest and there's a time to sow, right? And when you're sowing, there's nothing. And when you're harvesting, there is a bountiful crop. I think you have got to distinguish where you are in that entire investing cycle.
That's so true. I think, as Charlie Munger said, that investing is simple but not easy, right? So knowing the rules are all there laid out for us, but the not easy part, I think, how we behave and knowing where we are in the cycle, for example, is such a not easy part for investing. And I'm sure you've talked about that again and again. It's experience that teaches you, right? Going through multiple cycles rather than saying in the very first cycle that you've learned it all. Like I did when I joined the industry in 2003, 2008. First 5 years were the best bull market India has ever seen, right? By 2008, you start thinking of yourself as a master of the universe. Everything that you recommend to your clients turns to gold, right? And then you realize that you have mud on your face. A situation like 2008 comes, which is an external situation. But then again, I think that's such an important lesson that you shared, that you have to go through that phase yourself. You have to experience that yourself to really learn the lessons, and nobody else can teach you that. But that still, if you were teaching a class of say 2 or 3 hardworking, curious students who wanted to become investors, and you knew that at the end of the year-long course you had to hire all of them in your team, what are the most 2 or 3 non-negotiable ideas you will teach them about investing and investment behavior?
I think one is they have to be self-taught. Okay, and if they're always in alignment with me, with each other, that doesn't create a constructive debate.
Mm-hmm. That's it.
Okay. So I work in Kodak and I work in Cheka with a gentleman called Vetri Subramanian. Okay, and in his typical way of putting a team together is get people from with very different thought processes that get the debate on the table. Right? And I think that's what I would look for. And that's a culture that I'd like to build, because everyone thinks in the same direction, that everyone will make the same mistake and no one will know how to come through with it. So without experience, and that those qualities are when I say it has to be self-taught, those qualities are there because you read a lot, or you listen to a lot of points, and you bring a lot of your experience on how you think about what you've seen out there and put it together. And there's an experience of what you read on other investors that put it on the table and see whether those two things actually match. So when I look at youngsters that and try to build together, they definitely need to read a lot rather than listen a lot. Okay, they talk a lot, and that's a quality that I like. A lot of people need to listen, put things together, and be concise in how they articulate the thought process.
Is this the same advice that you would have given yourself, say 20, 30 years back when you were starting out, or is there something else as well that you would have told your 20-year-old self to deal with the world of investing and finance?
So my experience, like I said, I've been a loner for an extremely long period of time. I better say a loner, and not too many people that I talk to. But I only introspect as to what went wrong last year, or why a particular company is not done well for us, or why I bought a stock in a haste. And you basically rationalize yourself whether it's right, wrong, and then you correct your mistakes immediately. So it's actually the same thing. You go back to looking for a different opinion on an action you've taken, okay, and bring it to the table, and then execute the way you think is in your best interest. And then when I say in your best interest, my best interest is the investor's best interest.
Kenneth, what's a single best piece of advice you ever got in your life?
Actually, there have been many experiences that have been great. Okay, and I've been taught, and come to think of it, in 2000, you were at the peak of the tech cycle. Okay, and my colleague just mentioned to me is that after this is all over, we're going to feel very sorry for ourselves. Exactly a year after that, none of us had jobs. Right? And every time I see a cycle that goes similar, 2008, and to a very large extent, when I see some things happening in the marketplace today, and I say the same thing to my colleagues at this point in time. Okay, in 2023, I think it was 22. 2022, 23 March is when everything was not doing very well, but numbers were saying like something very different, and I basically said the same thing. Now the market will make money from you. No amount of analysis is going to work. And today, I say the same thing. Today, I say if you work harder, you make more mistakes. Okay, because that's the state of the market. If you work harder, you're going to fight something that you don't want to fight today.
Basically you're saying that you go down on the quality curve because you have nothing else to buy.
You try to look for value when nothing exists.
That's right. Are there any specific books or philosophies or thinkers outside of finance world that have shaped your approach to investing and decision making?
Not really. I used to read a lot of fiction earlier, but that's about where I used to, and that ended as soon as I found all the financial journals. And when it comes to financial journals, also I read a lot of. I used to devour the capital markets, the Wall Street business, India business, Today business, Word, and everything else that used to get published in India. I still do a lot of that currently, but it's on an electronic form at this point in time. But I can't think of anything anything apart from what is news.
Sure. Anything from the current investment reading space that you would like to recommend to investors? So this is separate from maybe 2 or 3 book recommendations that I want to seek from you, the best books that you would recommend to investors and decision makers. But apart from that, anything in the Indian reading investing space that you would recommend in terms of a journal or a magazine that people can pick up and learn about investing and markets and everything else?
So in terms of investing in the market, I again go back to the same principles. You can read all the great investors on how they put things together, and you find little bits of everything that is there that works for you. But you'll have to single out a single investor that has formed a thought process on how to put a portfolio together, and how to seamlessly put a portfolio together. And for me, if anyone ever asks me which book to ever start with or which book to end with, I start and end with just Beating the Street and One Up the Wall Street, which is basically Peter Lynch. He had a decade of brilliant career that went through, and it all came from the Fidelity spectrum. I mean, the latest was Joel Tillinghast, who ran the low price equity stock fund for Fidelity, which went out to be almost a $60 billion fund at its peak. And where it is now. So very simplistic in the way you actually pick companies, how to manage large pools of capital, how to buy enormous amount of companies out there, how to use the analysts well, how to use the information outside there, what are the questions that you go and ask, etc. Okay. So I think I just start with that. And Fidelity, at least the managers that they created between the 80s to 2010, the 3 gentlemen that were there, doing the one that managed the Special Situations Fund, Andrew Bolton. I think those 3 managers were very different in their approach to investing, but the results and the outcomes were exactly the same.
Couple of last closing questions. So first is the hypothetical question. Probably you may take a pause to think about it, right? So imagine, you need to imagine that you are going to lose your memory tomorrow. Right, and you have today evening to write down a letter to yourself so that you start over again with a certain amount of knowledge about how to get started and how to get going in life. What would you write in that letter to yourself? What are the key points that you would write in your letter?
I think so this is very interesting because it keeps periodically happening to me, and I used to go back to when I used to manage money at IDFs, and when I've managed money here also. I have a presentation that's always sitting on my desk. Okay, it was the first presentation that I made in 2008, 9, 10. Okay, every time I write class, I just flip pages and I put it back again. Okay, I did the same thing this time around. What to do? Went back to that presentation, flipped the same pages to again. And it's funny that you should ask it. I just did that last week. I flipped those pages again and I put it back. So that's been a constant with me. I have always revisited my past to see what has worked. The only thing that you reassess is the marketplace.
So what are those, if you were to share, what are those 2 or 3 of the entire presentation? What are those 2 or 3 lessons that you keep reminding yourself?
Okay. Buy when you're comfortable and buy when the stock prices are just right. It's very, the basics are very simple. Okay. You got to compound capital and that's where it is. Low price earning multiple and low growth. And that weight. Those basic 3 things that is there in all those presentations.
And here's my closing question to you, Kenneth. Everyone walks on their own journey of life and everyone must play their parts well. But what, according to you, is a life well lived?
I think life well lived is doing what you wanted to do always. And I think that's the journey that that's the journey that I've been through so far. So whatever I brought to the table, I think it's been extremely satisfactory. Okay, I've got a lovely family. I've got a lovely set of friends, close friends, which are there, and I've been able to put colleagues together that are that have worked well over long term periods. I think that's a small circle of where it is. You don't come. At least I haven't worked. I haven't come. I don't have a multifaceted personality, or I can't do multiple things. It's only one thing I can do is invest. Okay, and I found that sweet spot, and I'm just happy. I'm reasonably good about it.
Right, talking about that intangible of life, or intangibles of life, of having a close family and a close knit group of friends, and also doing what you love doing on a daily basis. I think that's a great point to end this conversation. Kenneth, thank you so much for your insights. Loved it as always, and I also want to take this opportunity to thank you for all the lessons that you've shared over the last many years that I have been an investor and tried to learn myself. So thank you so much.
Super, Vishal. Thank you. It was a pleasure talking to you, and thanks for inviting me to this podcast.
Thanks, Kenneth. Thank you so much.
Have a lovely weekend.
You too.